Everybody, we've got quite a few people coming in, so just give it a couple of seconds to stop the pinging. Potentially the pinging could go on for quite a while, actually, so I will I will start. So thank you everyone for joining our webinar, which is Crossing the Line, where we're going to talk about wrongful trading and misfeasant trading and kind of directors liability. Quite a significant webinar, this one, for us, not only because of the topic, but also we've got a special guest, but also it's our first webinar where we've hit over 1,000 registrants, which is just absolutely amazing. And my daughter reckoned I couldn't do this, but I'm going to, even more special for me because my daughter is actually on this webinar, so she reckoned I wouldn't be brave enough to give a shout out, but I have to. So there you go. So just to introduce your speakers, and I can move the slides. It's not working. First technical issue. Next, me. So I joined Manolete in May 2025, and I cover the Midlands region. Got 27 years experience in contentious and non-contentious insolvency law, so I think I'm the oldest one out of the speakers. Mentioned in Legal 500, and I speak regularly at conferences and deliver training for Legal Consultancy Limited as well. Then we have Brett, who's also an Associate Director at Manolete. He joined in February 2022 and covers the South West and the Wales regions. He's got more than 16 years experience in litigation and contentious insolvency law. Deals with lots of kind of high value complex insolvency litigation in the High Court, Court of Appeal and Supreme Court, and has a broad commercial perspective and has worked in private practice and also in-house at 2 major banks, which gives a slightly different kind of viewpoint on some things. And then we have our special guest, Laura, who's a partner at FRP. She's a forensic services partner, has over 15 years experience in forensic accounting, audit and advisory services. Specialises in complex, high-profile insolvencies, works quite closely with the insolvency team at FRP in terms of forensic accounting analysis, and was part of the successful team that secured the 2024 BHS wrongful trading and misfeasance judgment against the company's directors, which obviously we will be going on to talk about. If anybody wants to ask any questions, you can either do that by putting a question directly into the chat box, or if you want to raise a question but you don't want anyone else to know you've raised a question, I'm going to put my phone number in the chat box, and then you can just send me a WhatsApp or a text message and I will pick those up as well. So first off is Brett, who's going to talk through kind of the statutory framework and potential defences. Over to you,
Thanks
Brett.
very much. Thanks, Rachel. So yeah, I've got the slightly boring bit, so I'm going to cover an introduction and the basics of wrongful trading, including the statutory framework. I'm conscious there's a wide breadth of experience on the call, so we've tried to make it accessible for everyone. And then I'll also explore a couple of practical points in a little more detail. Before I launch into section 214, in very high level terms, for a wrongful trading claim to succeed, a claimant needs to jump over a number of difficult hurdles and show essentially the following. First, that a point has been reached when the company directors either knew or ought to have known that the company had no reasonable prospect of avoiding insolvent liquidation or administration. Second, that despite that, they continued to trade on. And third, that continued trading led to an increase in the net deficit, which would not have occurred if the company had ceased trading earlier. So in simple terms, you have to show that it was the continued trading which caused the increased losses in question. In certain circumstances, you can instead look at the new credit that was incurred after the potential points of no return, but that's not the usual position, and I'll explain that a bit more later. So next slide, please, Rachel. So if you look at section 214 of the Insolvency Act, it's actually been drafted in quite an unusual way. And that's because it starts with the relief that may be awarded. So the section is effectively in reverse. And the relief that the court may award is such contribution, if any, to the company's assets as the court thinks proper. Only then does it go on to set out when liability may arise. And that's in circumstances where you have a company in insolvent liquidation or administration. And at some point before that, the directors either knew or ought to have realised that there was no reasonable prospect of avoiding insolvent liquidation or administration, but continued trading on. Next slide, please, Rachel. So in this context, a director includes a de jure director, so one who's been appointed formally as a director at Companies House, a de facto director, so someone who may not have been formally appointed at Companies House, but is acting in practice as though they were a director, and shadow directors as well. Now, when most wrongful trading claims come across to us at Manolete, there's often no accompanying evidence or explanation as to the trigger point. So as to why it is said that the director either knew or ought to have known that the company had no reasonable prospect of avoiding insolvent liquidation at a particular point in time. Rather, what's often provided instead is evidence that the company was insolvent at a particular date prior to liquidation. And usually that's in the form of a balance sheet or management accounts at a particular date, which usually show a net deficit. Now, it's a trite statement that trading whilst insolvent is not an offence under the laws of England and Wales. Lewis and Jay said in the case of Hawks Hill Publishing, it's important to be clear about the relevant question. The question is not whether the directors knew or ought to have known that the company was insolvent. The question is whether they knew or ought to have concluded that there was no reasonable prospect of it avoiding insolvent liquidation. So trading whilst insolvent is obviously a high-risk situation for directors, and they should act appropriately and take advice, but it is not the trigger for wrongful trading claims. So the first thing you have to prove is that a point of no return had been reached. How do you prove that, particularly when the company records are often seriously lacking, sometimes lost in a theft, flood, or a fire? It's always amazing how everything else seems to escape completely unscathed, apart from the books and records. But in my experience, there are various ways of proving that the point of no return has been reached. And that is essentially to start by considering the types of issues that you would when initially advising a director as to solvency. So it's to ask yourself, what advice would you have given the director if they'd come to you at the posited points of no return? Was the position truly hopeless or not? Now, IPs on this webinar will be far more expert at determining that than me. But just to give a few examples by way of illustration. So in terms of cash flow insolvency, an analysis of prior profits and revenues can be really helpful. And that can usually still be done even where books and records are lacking. So for example, hopefully as the liquidator, you will at least have the company's annual accounts, potentially even the full accounts, and not just those filed at Companies House. And you can therefore look at the company's historic annual profits. And if the company was making circa 20k of profit annually on average when times were good, but has a 500k hole in its balance sheet, then profitable trading alone is going to take a very long time to remedy that hole, and most creditors are not going to wait that long. Further, the mega contract that's supposedly going to come in and turn the company's fortunes around is going to have to be both pretty enormous in terms of size, but also incredibly profitable in terms of profit margin to make a difference. And all of that starts to form a picture that the point of no return has been reached, and that the directors ought to have appreciated that. Another source is creditor information, so information about what the creditors were being told and about the level and state of their debts. And finally, there is also internal emails. So I had one case where the finance director repeatedly sent emails to the board expressing his concern about the financial position of the company. Those emails and the points he was making were largely ignored. And after a number of months, that culminated in quite an exasperated email from him, in which he said the company was doomed and resigned immediately. The company continued to trade on for 16 months and collapsed into heavily insolvent liquidation at the end of that process. So that's a rare example, but quite a nice one if you can find it. Most of the successful claims in this area are claims where the directors ought to have known. So more particularly, cases where the directors exercised no real care or oversight. So cases where they didn't have any reliable, regular accounting figures or systems, and paid little or no attention to whether the company was solvent or not. Or close their eyes to the reality of the situation. And further, usually in the successful cases, the directors did not take advice from IPs, or if they did so, they only took that advice at the very end and well past the point of no return. Next slide, please, Rachel. So often directors will respond by suggesting that they did have a valid reason for believing that things would turn around. Now, if they do that, they'll need to show a rational basis for that belief. Blind optimism, or McCahill, as it's often known, won't suffice. So a slight tangent that explains this picture of David Jason. But McCahill is a term which features in a number of the wrongful trading cases, or the judgments on the wrongful trading cases. And I'll confess, I didn't actually know what it means. But apparently it derives from the Charles Dickens character Wilkins Micawber. This is a picture of David Jason playing him. And that character appears in David Copperfield. And Mr. Micawber was perennially in debt. And a bankrupt. He ended up in a Victorian debtor's prison, but constantly held the belief that something will turn up, and was famed for his continually misplaced optimism. So a final plea on the point of no return from us at Manolete. So where possible, when sending over a potential claim for consideration, please do try and include explanation as to why, in your opinion, the company had no reasonable prospect of avoiding insolvent liquidation or administration at the posited dates of no return. That will maximise the chance of getting the claim funded or purchased. So moving on briefly now to the second area, which is defences. So the primary statutory defence to wrongful trading under section 2143 of the Insolvency Act is that the director took every step with a view to minimising loss to creditors. This is a very high hurdle for directors to overcome because it refers to every step. Further, the onus is on the director to prove that that defence is made out. And notably, to rely on this defence, a director not only has to show that he took every step with a view to minimising any increase in the net deficit to creditors, but also that he took every step to ensure individual creditors were protected as well, and that some creditors weren't being preferred over others or at the expense of others. For misfeasant trading, there is the usual statutory defence, section 1157. That is that the director acted honestly and reasonably and ought fairly to be excused. Again, this is a high hurdle for directors to overcome. And usually, whilst the director may have acted honestly, if his actions have caused losses, it will be hard for him to convince the court that it was reasonable to continue trading after he ought to have realised that the position was effectively hopeless. The key battleground in these cases in terms of defences, so if you can show that the point of no return has been reached and you move on to the defences, the key battleground usually revolves around the losses, if any, which have been caused and the extent to which they are attributable to the continued trading. So unhelpfully, section 214 does not explain how the court is to assess the losses, but gives the court a wide discretion. And so you have to look to case law as to how the loss is to be assessed. And there are generally two types of cases. So one where there are no reliable accounting records at all. And so it isn't possible to sensibly try and quantify the increase in net deficit. In those cases, an approach that has been adopted is to simply look at the amount of new credit that was incurred after the point or points of no return had been reached. And that is what some cases have done successfully, in particular re per point and re kudos. The second and more usual and unfortunately more complicated way is where there are some accounting records, and that involves calculating the increase in net deficit that has been caused by the continued trading. So that continued, albeit wrongful trading, has to make the company's position worse so that it has less money to pay creditors. And this approach means you have to exclude any losses which are an inevitable consequence of the liquidation. So losses which would have been sustained irrespective of whether the company had ceased trading at the posited points of no return. So these types of excluded losses are things that occur not because the company continued to trade after it should have stopped, but solely because the company has gone into a process. So to give you some examples, this could be redundancy costs of employees, liabilities under a lease or for rent, which would have occurred had the company gone into liquidation earlier, liabilities under liquidated damages clauses in contracts, and you'll see that in the construction industry a lot, if they would have arisen had the company gone into liquidation earlier. And finally, debtors refusing to pay simply because the company has gone into a process, so effectively write-downs on assets. Put simply, in respect of those types of losses, it was not the director's decision to keep trading which caused them, but the fact of the liquidation itself. Now, the approach we often see again when cases are referred across to us is to take the balance sheet at the point of no return date, or as close to that as possible, and compare it to the statement of affairs figure, -1 from the other, and use that as the increase in net deficit. Unfortunately, that's not quite the correct approach, as it reflects only the start of the exercise. You then have to go on to consider whether the increase was caused by continued trading or some other fact, and strip out any losses which would have been sustained even if the company had gone into a process at or before the posited points of no return. So Rachel and Laura will now cover in more detail in their sections some practical examples from both case law and their own experience, which examine some of the issues I've mentioned and help put them in context.
Okay, thanks, Brett. So I'm going to look at kind of when liability arises. I'm going to do that by looking at a recent case which was heard in 2025, which was the Stacks Living Limited versus Shergill case. And as with a lot of cases, you know, it's sometimes difficult to separate all of the, all of the different points. But Just to give you a bit of background to this case, there were two companies, Stacks Living Limited and Stacks Furnishing Limited, which both entered insolvent compulsory liquidation after winding up petitions were presented by their local borough council for failure to pay non-domestic rates. And the companies didn't oppose the petitions at all. Mr. Shergill was the sole shareholder of both companies and controlled and managed the commercial and financial operations, apart from a very short period of time between the 17th of July 2018 and the 19th of October 2018, where Miss Miranda Smith, who was Mr. Shergill's partner, was a director. But apart from that very short period of time, he was the sole appointed director. By her own admission, Miranda Smith had no involvement in Staffs Furnishing Limited at all. There were various heads of claim brought against Mr. Shergill and Miss Smith, but I'm just going to look kind of at the, at the wrongful trading and then just pick up on one element in terms of a defence. So the claim that was brought in relation to wrongful trading was that the relevant date was about the 31st of July 2018, when they knew or ought to have concluded there was no reasonable prospect the company could have avoided insolvency, and that they then didn't take any steps to maximise the potential loss to creditors. Both were held to be liable for wrongful trading. Regarding Mr. Shergill, it was held that it was practically inevitable that he should have known the position from at least the 31st of July 2018. The court said that it would have ordered him to compensate the whole of the net deficiency created between 31st of July 2018 and the date of liquidation, but there was also a claim brought against him for fraudulent trading, and so the loss was dealt with kind of under the fraudulent trading heading. In relation to Miss Smith, there was a bit of an argument about splitting duties, whether directors can kind of split duties and say, well, I'm not responsible for those particular kind of, decisions or responsibilities. It's very rare that you're going to be able to do that unless you're probably in a really big organisation where you might have, a finance director, a purchasing director, a resources director. But she argued that, effectively that the duties had been split. She argued that she didn't know the position regarding one of the companies. But the court felt that she should have taken, at the very least, elementary steps to familiarise herself with the position. And the court said that a director is under an irreducible duty to inform him or herself, at least to some extent, about the company's business and affairs. She was the company's only appointed director, as she must have known, given the circumstances of her appointment. So I think that's quite useful. We will quite often get defences from, directors saying, well, I was only a director in name only, it's nothing to do with me, I wasn't involved in the business, and they think that that's a defence, whereas actually that can almost open them up to more claims, because the court's quite clear that you shouldn't take that appointment. You do get responsibilities as soon as you take that appointment. And then so then in terms of the judgment against Miss Smith, she was held to be liable in respect of the increase in net deficiency between 31st of July and the 19th of October, which was her period of appointment. There was also kind of misfeasance and breach of duty claims brought against her, and she tried to argue the section 1157 defence, which Brett referred to earlier. And whilst this isn't strictly relevant for wrongful trading, it's helpful in terms of kind of the things that the court will look at, because the court said that at the time of the trial, she'd been working in the Children and Families Department of the County Council for 21 years. So she wasn't even really involved in the business. She had another full-time job. They accepted the evidence that Mr. Shergill had prevailed upon her to become a director, which she agreed to, even though she had some misgivings in relation to that. But that she was appointed, she knew she was appointed, she did agree to the appointment, and therefore she was, during that period, subject to all the usual duties of a company director. So again, kind of knocks on the head one of the frequent defences that we see. He also declined to reduce the amount of her contribution because of the circumstances in which she was appointed. He said that the fact that she'd kind of been pushed into making the appointment was irrelevant. The fact that she wasn't really involved in the company was irrelevant, because if they allowed those arguments to stand and thereby reduce the sum that she was kind of, made to order back, then she would actually be benefiting from a reduction based on her failure to know about the company's affairs, in circumstances where it's that failure to know about the company's affairs which actually constitutes part of the wrongdoing. And so he declined to grant her any relief, because whilst he felt that she had been honest, she hadn't been reasonable. So again, it shows kind of what Brett was saying, that hurdle can be it's a defence that can be quite difficult to kind of argue, because there are various hurdles. You have to prove that you're honest, then you have to prove that you're honest and reasonable, and then you have to prove that you're honest and reasonable and then ought fairly to be excused, which can be quite difficult. So in terms then of kind of how do you calculate what you're actually claiming, I'm going to hand over to Laura to talk about the net deficiency and also the BHS case.
Thanks very much, Rachel, and morning, everybody. So yeah, we're going to talk about the kind of practicalities of how you actually calculate the net deficiency and what it ultimately means. So if we can just move to the next slide, Rachel. Thank you. So just to go back to basics for a second, and explaining in practical terms what Brett and Rachel have just said. So as we know, if we start off with the net deficiency to creditors and what that means, so that's just effectively the difference between the assets available in a wind down scenario against the body of creditors, so the assets available to pay back those creditors. Now, as we all know, a deficiency would normally be expected in a wind down scenario, and therefore that's why creditors would obviously receive a pence in the pound distribution, i.e. part distribution against their liability. So taking that, the increase in net deficiency is then calculating the combined movement in both the assets and the liabilities between two different dates. And I've put a table on the slide here just to explain that a bit further. So if we assume that our alternative date for insolvency was the 1st of February 2019, and the actual date of insolvency was 15th of March 2020, so we would take the asset position at both dates, the liability position at both dates, and look at the movement between the two. And the increase in the net deficiency is the combined movement in those figures. So as you can see in the bottom right-hand corner of that table, the increase in net deficiency would be 16 million. Now, the movement will often be a depletion in assets. So as you can see here, the assets have gone down from 6 million to 1 million, and an increase in the liability position in cases of wrongful trading. So again, the liabilities have gone up here from 49 million to 60 million. However, that doesn't always have to be the case. It doesn't always have to be a movement in that direction. There just needs to be an overall increase in net deficiency once you combine all the numbers. Next slide, Rachel. Thank you. So in terms of what you actually need to calculate your IND, the most important point is to establish your counterfactual knowledge dates. And as Brett's already explained, you need to establish as part of your legal case what date you consider the directors knew or ought to have known that the company couldn't avoid insolvency. So that alternative date, or knowledge date as it's often referred to as, will be an earlier date than the date the company actually went into an insolvency process. Now, often as part of your legal case, you might have more than one alternative knowledge dates, which effectively creates more than one counterfactual scenario, and that will be subject to the facts of the case. But that may mean that you might have multiple calculations for IND as well, based on the different counterfactual scenarios. Another thing that's important to consider is that when you're producing your figures from the counterfactual scenario, just taking the balance sheet at that particular date, whether you've got access to management accounts or maybe statutory financial statements, those assets and liabilities in those documents are prepared on an accounting basis under accounting standards, and usually on the assumption that the company is a going concern. However, when you're creating an I&D and when you're creating a counterfactual, you're assuming that the company in question is in a wind down scenario, and therefore the figures that are taken from a balance sheet aren't necessarily appropriate to use for the purposes of an I&D. So it's important to prepare an estimated outcome statement, which, as I'm sure for all the IPs who are joining the call, are very familiar with, but it's effectively looking at the assets and liabilities available in a wind down scenario, and as Brett has already said, comparing that to the actual estimated outcome statement of affairs, the position on actual insolvency. Now, a few reasons for why assets and liabilities on a balance sheet shouldn't be relied upon for this purpose. So, for example, pension liabilities may be recorded in the accounts at a particular figure, subject to a valuation that may be done every 3 years, for example, an actuarial valuation. But in a wind down scenario, those pension liabilities will often crystallise on a Section 75 basis and generally significantly increase. So if you were to include the accountancy figure, that wouldn't be the true figure to consider in a wind down scenario. Another example is deferred tax. So deferred tax will often be a debtor on an accounting balance sheet, and if the company is expecting to continue to be profitable going forward, that deferred tax may be able to be used to offset against profits going forward to reduce your tax balance going forward. However, in a wind down scenario, that deferred tax asset isn't going to be realizable. It isn't worth anything in a cash terms, and an insolvency practitioner isn't going to be able to realize anything, unless, with the small exception, you might be able to transfer to another group company, for example, but generally that's not going to be a realizable asset, so you wouldn't include that in your estimated outcome statement. And then finally, another often complicating factor when looking at the position in an insolvent group, and if you're calculating I&D for a series of group companies, the where you've got intercompany debts or cross-guaranteed debts in that group, you'll need to assess them for the likely realizable value and any subrogated claims that may exist as part of your calculation for I&D. Thanks, Rachel. So we're going to go on and talk about the BHS case. So I'm sure many of you will be familiar with it, but just to give a little bit of background for those of you that may not be. So the BHS Group was purchased by a vehicle called Retail Acquisitions Limited on the 11th of March 2015, and that was purchased from Sir Philip Green, and he held the BHS Group for several years at the same time as he held the Arcadia Empire as well. He sold it to Retail Acquisitions, which was headed up by a man called Dominic Chappell. Now, just over a year later, on the 25th of April 2016, so about 13 months later, all the companies in the BHS Group, including the trading company, entered into administration and shortly afterwards liquidation. Now, in that 13-month period, the group entered into a number of different transactions, and FRP, who were the liquidators of BHS, we brought a wrongful trading claim against the directors that were in situ post the sale, so the post-sale directors, for both wrongful trading, misfeasance trading and misfeasance. And we argued that the decisions that were taken and the transactions that were entered into left the BHS Group and its creditors in a significantly worse position than they would have been if they'd entered administration at an earlier point in time. Now, going back to what I was saying about multiple different knowledge dates, in this particular case, we established 6 potential dates for insolvency to create 6 different counterfactuals for the court to consider. So bearing in mind the actual insolvency was April 2016, we put forward to the court that insolvency should have taken place on 6 dates between the 17th of April and 8th of September 2015. And that was all based on different sets of facts and different transactions that were entered into at those particular points in time. We were successful in establishing wrongful trading on our final date, which was the 8th of September 2015. So Justice Leach found in his judgment that the directors were liable for wrongful trading from that particular point in time. In relation to the misfeasant trading claim, which, as we all know, has kind of become a bit of a kind of newer concept following the Sequana judgment and following the creditor duty, we're now starting to see more case law coming out of that. And this case was the first time it's really been tested in court what kind of misfeasant trading actually means and how you would quantify it. And in the BHS case, the judge actually found that the directors were liable for misfeasance trading from the 17th of June. So it was actually an earlier date from what he found in relation to wrongful trading. Now, when it comes to calculating the I&D in relation to those, so we obviously had expert evidence as part of the trial, and the experts actually pretty much agreed the figures for the I&D at each of the different dates just before we went to trial. The experts were still cross-examined on various parts, but in terms of the actual figures, they were effectively agreed. And the position at the June date was that the I&D was 133.5 million, and at 8th of September 2015, the I&D was 45.5. So that's the figures that the judge had to work with as the potential quantum for him to consider, and obviously at the court's discretion as to whether that amount was awarded or not. If we just go to the next slide.
Can I just ask you a question, Laura?
Of course.
So how did the misfeasant trading claim actually come about? So
originally, when we first were considering and putting forward the claims, we actually started off the process with just considering a misfeasance claim, actually. And when our counsel, Joseph Curl, KC, came on board, he said, if this was ever a case for wrongful trading, if there was ever a case for wrongful trading, this will be it. So then we put forward a wrongful trading claim, we did the particulars for that in 2020. And misfeasance trading was mentioned in those particulars, but as we know, there isn't actually a statutory test for misfeasance trading under the Insolvency Act. It's something that's kind of developed out of Section 212 in terms of misfeasance, and obviously out of a breach of the creditor duty under Sequana. So, as I mentioned, this is kind of the first case we're really seeing case law in relation to it. And it was part of opening submissions, closing submissions in trial, and featured a big part of Justice Leach's judgment in relation to this. But in terms of the actual quantum for misfeasance trading, because it's such a new area of case law, the judge in our case actually asked the parties to come back and give further submissions on quantum, just because it was such a new evolving piece of case law.
Yeah. Okay, thank you.
And in terms of what was actually awarded, so as I mentioned, the directors were held liable for wrongful trading and misfeasance trading. Now, each of the respondents in question were the directors in relation to this case. So we had Mr. Dominic Chappell, as I mentioned, he was held liable for 50%, Mr. Henningsen and Mr. Chandler 15%, and then two further candidates held liable for 10% each. Now, that was based off the I&D figure at September, because the wrongful trading date was held from September. So that was based on the expert figures, which the judge accepted and utilised those figures, with the exception that a small credit was given in relation to a settlement that we achieved with one of the other directors shortly before we actually went to trial. In the misfeasance trading judgment, as I said, we had to go back and give submissions and had a further consequentials hearing. And that hearing also dealt with the severed proceedings of Mr. Chappell. Mr. Chappell wasn't actually part of the trial that we had in December 2023. He was a live defendant or respondent up until the week of trial, and he did come and join the proceedings, and the judge decided to sever him and manage his defence and his trial separately, which was done 6 months later. But then 6 months later, as part of that second judgment, he was held jointly and severably liable for misfeasance trading with Mr. Henningsen, and for the wrongful trading as well. Between the trial and the judgment, we actually settled with Mr. Chandler, so he doesn't have a judgment against him in relation to misfeasance trading. Now, you might be thinking, when we compare the figures to what we had on the previous slide, so I noted that at June 2015, the I&D was 133 million, but as you can see here, the judge only awarded a quantum of 110 million against Mr. Chandler and Mr. Henningsen. And the reason for the movement in the figures there is that the judge held that the directors couldn't be held accountable for the movement in the pension deficit between June and September, because that was in relation to effectively market forces and factors outside of the directors' control. So that movement was actually eliminated from that calculation, along with another small credit of 4 million, and that resulted in the overall award of 110. The judge decided to include the pension deficit in the wrongful trading figures because those I&D figures were effectively agreed between the experts at both sides. So the judge decided that that should be the figure that was used for wrongful trading. But in relation to misfeasance trading, again, because it required additional submissions and such a new area, the judge was wanted to consider the factors that the directors weren't liable for in the June figure, particularly as it was obviously so much higher as well. So that's the reason why the figure was awarded was slightly different.
Okay, great. Thank you. We've got lots of questions coming in. So I'm just going to move on to the final part and then we can pick up the questions if that's okay. I think what I'm about to talk about might answer your question, Yasmin, but let me know if it doesn't. So just wanted to pick up as a final point really on kind of risks associated with wrongful trading, and I guess the same principles will probably apply for misfeasant trading in terms of risks even if you get a judgment. So I've just picked up on 3 cases where I think kind of quite highlights this. So it's a bit like what Brett was saying in relation to the section 1157 defence. There are various hurdles that you have to overcome, and that's the same for, you know, for the wrongful trading. You have to establish wrongful trading, you have to establish that there's been a net deficiency, then you have to kind of get that contribution in relation to that net deficiency. So in Recontinental Assurance, there was an estimated deficiency of about 14 million. The court held that there wasn't wrongful trading in that case, but they still went on to issue to look at the issue of quantum. And what the court said was that the court wasn't satisfied that the liquidator's evidence could be relied upon to support the allegation of increase in the net deficiency. This is kind of a point that's also picked up in the Robin Hood judgment, which I'll talk about in a minute. The main point really from kind of Recontinental Assurance in terms of the risk of bringing claims is that the judge picked up on the point that he didn't feel necessarily that a liquidator is the appropriate person to provide kind of the evidence in relation to the increase in net deficiency, and felt that really that was kind of for an independent expert. So I guess, and as Laura said, you know, they had experts, independent experts as well in the BHS case. So just a warning point as well, if you're calculating the increase in net deficiency, then you need to consider whether or not to have kind of some, you know, independent expert advice in relation to that. In Robin Hood, this is a really interesting case. I find it interesting, but then I'm sad, so I would find it interesting. So this was a case, was a wrongful trading case, which went to appeal. So there's a first instance decision and then a High Court decision. I'm going to pick up on the first instance decision because I think this is one of the points that kind of gets lost in the Robin Hood case. The liquidator had costs of round about £1 million. At first instance did get an order for wrongful trading. I think off the top of my head, the claim was for a net deficiency of around about £780,000. The amount that was actually awarded by the court was £35,000. There's a significant difference between what was awarded and what was claimed. General rule is that the losing party will pay the successful party's costs. But there was the registrar felt there was an issue because they got the order for wrongful trading, but were awarded less than the amount that they had claimed, and felt that as a consequence of that, the liquidator there were a number of important issues that the liquidator didn't actually succeed on. So in terms of costs, the registrar felt that he had to distinguish this case and look at the work which had been carried out in relation to the elements of the claims which had succeeded, and the work carried out in relation to those elements where the claim didn't succeed, or to put it another way, where the defence was successful. The liquidators had failed in relation to 3 specific dates prior to the 31st of January, which was the date that the court then settled on. And obviously work had been carried out in relation to each of those specific dates, because they had to set the scene for the financial circumstances for each specific date. But the court felt that they had kind of lost on 3 of those dates and succeeded on 1. In addition to that, whilst they had kind of succeeded on 1 of their dates for the wrongful trading, then the directors were successful in raising a minimising loss defence for a period of time after the date which they knew or should have known that the company couldn't avoid insolvent liquidation. And then there were various kind of things cut out of the calculation of the increase in net deficiency, the landlord and the landlord's claim being one, which is something that Brett mentioned early on. So taking all of those matters into account, the registrar felt that it was probably arguable that about 60% or more of the litigation was engaged in issues on which the directors succeeded on, i.e. the defence was successful, but felt it would therefore have been wrong to award the applicants 40% of their costs for the bits that they succeeded in, because that didn't then take into account the fact that the directors had incurred costs themselves on matters in respect of which they were largely successful, and actually felt that the directors had a stronger argument for costs against the liquidators rather than the other way round. But in order to award the directors costs, that would overlook the fact that the applicants had succeeded in part of their claim, and the directors should have recognised that there was a case to face. And the registrar stated that the directors' decision not to back down had to be viewed in the context of a very substantial claim, which to a substantial extent had been shown to have been incorrect. A wholly different approach might have been adopted if the claim had originally been drawn to its proper scale with regard to the basis for the amount claimed, the quantum and the costs involved. It is to be borne in mind when considering conduct that the respondents were facing a claim with costs on a conditional fee basis, which would be potentially ruinous. If an applicant presents a largely misconceived claim with an unattainable quantum, it can be unfair to criticise the respondent for failing to settle and for adopting an intransigent approach. So I think that's a warning, really. We all think it's great, we can plead more than 1 date in terms of wrongful trading claims, but there is also a risk associated with that. So I think if you are going to plead more than 1 date, you kind of, there needs to be really good rationale for each of the dates that you're claiming. And then re-rules building. In this case, again, there was wrongful trading order, but there was found to be no increase in the net deficiency. And the question then arose as to whether or not the directors should be ordered to contribute back to the estate an amount to take into account the costs and expenses by which the insolvency process had increased because of the investigations they'd undertaken into the wrongful trading claim. And the basic principle is no. The court said that the expenses of investigating and bringing a claim aren't normally recoverable actually in the claim. You have your litigation costs, which are different, but kind of getting up to that point aren't usually recoverable from the other side. And they didn't feel that, that kind of a wrongful trading claim raised any kind of special circumstances which would kind of direct the court to move away from that, from that general principle.
And on re-rolls there, Rach, I think that was one where the point of no return ultimately was only about 6 weeks before the liquidation, but the losses being claimed were over £1 million. And so it was a case, I think, where the judge felt there was a going concern balance sheet being compared to a statement of affairs that was prepared on a wind down basis. And effectively what the claimants were saying is that the company had sustained over £1 million worth of losses in 6 weeks. And the judge said, look, that's just not realistic. you've got to compare like for like and strip out things that would have happened had the company gone into a process 6 weeks earlier. And once you do that, it seems that almost no loss was actually incurred. And if anything, there may have been a slight profit during that period, I think they were suggesting. So yeah, that the case sort of encapsulates everything that we've been discussing.
Yeah. Okay, we've got quite a few questions, and there's quite a chat going on in the chat box. So one question I've had, which I find really interesting. So Brett, you might be able to answer this. I read the questions out, you can answer them. I'm only joking. Is it correct that company secretaries are open to more criticism or challenge alongside directors in relation to antecedent claims, or wrongful trading? I mean, wrongful trading you can only bring against a director, but obviously misfeasant action relates to any officer of the company, of which a company secretary is, in theory, an officer. But I don't think I've ever brought a claim against a company secretary. Have you?
I don't think company secretaries owe the same duties that directors do under sections 171 and following of the Companies Act. Certainly, I've never
but under
seen one.
Under section 212, I had to get my
book
out. Has been an officer of the company, misapplied or retained or become accountable for any money or other property, or has been guilty of any misfeasance or breach of any fiduciary or other duty in relation to the company. So I guess it's possible. I'm not really sure under what circumstances you would go after a company secretary as opposed to the director, unless they've done something blatantly, wrong in relation to
I've
filing of accounts and things like that. Laura, have you ever? Laura's not.
Sorry, Rachel, I lost you there. Slight connection issues.
Have you ever seen a claim against a company secretary for any of these kind of?
No, not in my experience, no.
Okay.
Just on sorry, I was going to talk about there was a question from Yasmin about how the court approaches multiple possible insolvency dates. And I think the key point there is you need to plead all of the dates that you're relying on. So the court won't come to a decision of its own volition as to a particular date. So if a date hasn't been pleaded, then the court can't find a sort of an alternative date. And it's for that reason that claimants normally posit a few potential dates within the time frame to make sure that they at least hit one of them. Usually the last one in the chronology. So sort of as you get closer to liquidation.
Yeah, but then that has to be balanced against the risk that you face in terms of costs, looking at the Robin Hood. So you can't just pluck those dates out of thin air. There's got to be kind of some real rationale behind them.
Yeah, and I think that ties into another comment that someone's written, who's an IP, I think, about not overstating the claim, kind of the importance of that. I think. I've
got a text message, another text message question come in. So this probably one for you, Laura. Can I check, and just to be clear, the increase in net deficiency is the change in the estimated outcome statement position based on the counterfactual, e.e. going sale or insolvent closure, not based on the management accounts net book value of assets and liabilities, excluding non-cash items, e.g. deferred tax. So all assets are likely to be discounted from net book value to some degree. Also, presumably, rather than comparing to statement of affairs values at actual date of actual insolvency, the comparison is to the actual insolvency outcome, not the statement of affairs, because the director's estimate may not be right in the statement of affairs.
Yes, completely agree on both points. It definitely shouldn't be the net book value. It should be discounted to reflect what's realizable in an insolvency scenario, and the true liability position, including any kind of crystallized liabilities, as I mentioned, and agree with the statement of affairs. I think perhaps when you're starting off considering a wrongful trading claim, you might use that as a starting point. But if you're ever kind of going to bring it all the way through to trial, you would take the actual insolvency position, looking at progress reports, looking at exactly what the liability and the creditor's position was, not just the statement of affairs, because as you say, Rachel, that's just an initial estimate.
Yeah, I'm just scrolling through the questions. Are there any scrutiny over lenders or investors who do not perform strong due diligence and provide new credit after the point it could be deemed a company was involved in wrongful trading?
That question has come up quite a bit when I've talked about the BHS case on other occasions, and in fact, in that particular case, there was lenders that were approached in relation to the sale of BHS to Retail Acquisitions, and some lenders did do their due diligence and actually refused to lend. I think they identified the fact that the new incoming board didn't have any retail experience, for example. They identified what it might take to actually turn this business around, and they chose not to lend, whereas obviously there was some lenders that did decide to lend but actually made a lot of money in this scenario, and that was linked to some of the transactions that we identified in relation to wrongful trading and the decisions that the directors took to actually undertake that lending. Now, whether there should be some criticism of those lenders of actually almost taking advantage of that situation, and at one point we did consider extortionate credit claims, for example, but at the end of the day, they took advantage of a commercial opportunity and did that commercial opportunity. And in that particular case, the critique was more on the directors for choosing to take that decision at the ultimate expense of creditors.
Yeah, I guess,
and I suppose also you don't want to put sort of bona fide lenders off from lending in distress situations, which may kind of, help the company. I appreciate BHS was probably outside of those parameters, but yeah, that's the counterpoint.
I guess it's also similar to kind of the bounce back loan claims, isn't it? That when they first arose, people thought that there would be a claim for misstating kind of turnover in order to get more from the bank in respect of to get a higher, qualify for a higher amount, where the courts have said, well, actually, the company did benefit from that money. So, okay, if you then misuse that money after the event, that's a separate head of claim. But just getting the money in on its own, the company is benefiting from that. So I guess a court might very well take a similar viewpoint in relation to lending at that point. Obviously different if it's an extortionate credit transaction, because that's a kind of a specific claim with set parameters. But if it's just a commercial opportunity, I think it would seem harsh, because the lenders are parting with that money, aren't they? It is going into the company.
There was a separate question, Rachel, about how you prove someone's a de facto director. And the answer is it's difficult and it's a thorny issue, but you'd look for evidence of what the director was doing. So, for example, you could look at the company's website. I found that the Wayback Machine, which images companies' websites sort of historically, and that's a free resource, quite helpful, because it may be that that person was listed as a director on the website. You could look at their emails, see if their email signature was holding them out as a director. Were they signing contracts on behalf of the company? Effectively, were they doing things that only a director could do? Another one is the bank mandate. That's quite an important one. So did they have control of the bank account? Again, that's something that ordinarily would be the preserve of a director in a smaller company. So it's trying to find things like that. Obviously, if you've got the email servers, that could be very helpful. I suppose evidence from other employees about what the person who you're saying is a de facto director was doing, and the decisions that they were making. That those types of things is what you're looking for, really.
Yeah. Okay, well, that takes us to bang on 11 o'clock. Though, one more question. You mentioned bounce back loans. Has there been a ruling since Kieran Bork and Tunlock versus Lucian Tenaru? I don't know. Is the answer to that question?
Yeah, we've certainly had a number of successful bounce back cases, but I'm not sure if they're reported decisions generally.
Well, I think we've still got some questions coming in. So if people want to stay on to deal with those questions, that's great. We can stay on. But if people want to leave, then that's absolutely fine. Thank you everyone for attending. The recording and the slides will be sent out in the next couple of days, and then our next webinar will be on the 15th of September, just taking into account kind of the summer holidays. Thank you. Right. So the question. It's popped off my screen now because there's a question for Laura.
Yeah, I'm just looking at that one.
Yeah, and then Brett, one for us. If a case is given to Manolete early, do you engage professionals to prove the claim? Then I presume this can be part of the claim as opposed to as IPs doing it and it not being part of the claim.
No, so
go on, sorry.
Yeah, I mean, Rachel, certainly, I guess in my case, we'd normally rely on the liquidator initially, and sort of discuss the issues that we've discussed on this call, to try to sort of come to what we think is a reasonable sort of ballpark figure. And then normally we'd see where we get to pre-action, I think, with that. If that's not successful, then obviously, and we have to issue proceedings, then I think at that point we'd look for a view from an independent expert, maybe not a formal expert report at that stage, but at least a sense check that they don't sort of disagree with our combined kind of conclusions. Rachel, is that the same for you, do you think?
Yeah, I think obviously the earlier we can get involved, the better. But I've just lost the question now. There's lots of things pinging on my screen. So we'd need an indication, I think, as to what the IP thinks the increase in net deficiency is, and the relevant dates. But I think, as you got closer, then you'd knife and fork it a lot more. And I think bearing in mind kind of what a lot of the case law has said, then I think if we were to go to trial, we'd want expert evidence, which obviously, if the case is signed over to us, then we're paying for it at that point.
Yeah, but I mean, often the IP has met the directors, and it's just useful to get a sort of sense from them as to whether these were reasonable people or not, and things which also help.
Laura, are you picking up on that question?
Yeah, I think the only comment I would say is, I totally take the point. I think trading losses don't always equate to the same thing as I&D. Interestingly, in the BHS case, we actually calculated that. We actually calculated the trading losses and the movement, and the numbers were actually very similar. But I appreciate the point that may not always be the case. I think in the circumstances that I&D is generally the accepted method by the court, and it is the loss to creditors ultimately, that's the figure that you go with, even if that's slightly different to trading losses. But I take the point.
Part of the problem with it all, I think, is when Section 214 was enacted, I think what Parliament had in mind was the incurring of new credit, and effectively that if the position was hopeless, directors shouldn't be incurring new credit when they know they're not going to be able to pay it back. But unfortunately, that's not how it's been interpreted by the courts. And the reasons for interpreting the way they have are rational and make sense. It's a group remedy, wrongful trading. It's for the unsecured creditors, and so really it should only apply if they've lost out as a sort of overall, rather than looking at the positions of kind of individual creditors and new creditors being worse off than old creditors. But unfortunately, it's the increase in I&D is the usual sort of method, and really you are trying to look at trading losses and sort of identify those kind of pure trading losses in that period, but as you say, only if that has actually worsened the position for creditors overall.
I think that's all the questions. Not got any more text messages. Great. Well, thanks everybody for attending and for giving us your time. Our contact details are on the last slide, which you will obviously get anyway in the next couple of days. But if anyone's got any questions they want to pick up separately after the event, then please just drop us a line and we'll get back to you.
Thanks everyone.
everybody.
Thank you.